This is going to be a homework walkthrough of chapter 12-3. We'll start with question 1. The management of Kunkel Company is considering the purchase of a $36,000 machine. Okay, let's put that down here, 36,000. That would reduce operating costs by $8,500 per year. So there's my savings of $8,500 per year. At the end of the machine's 5-year useful life, it will have a 0 salvage value. So no salvage value. The company's required rate of return is 13%. Okay. They want us to determine the net present value of the investment in the machine. So we're going to have to perform some calculations. First, I'm going to show you the long way to do this. And that's with the discount factors year by year. So this for year 0, which is now, that's going to be a negative of the machine purchase, right? Because that's a cash outflow. So negative 36,000, and then years 1 through 5 is going to be 8,500. I'm going to anchor that cell with the dollar signs so that I can drag that down because it's the same for each year, 1 through 5. Okay, so there's my in and out of my cash. And now here, if I wanted to, I could go and look in the appendix of 12B-1, and I can find these numbers by looking for my 13% and then year 1, 2, 3, 4, 5, and get that decimal 3-digit number. Instead, I'm going to show you how to use this present value formula, which is 1 divided by 1 plus the rate raised to the value of which year it is. So for year 1, it will be equals 1 divided by, parentheses, 1 plus the rate close parentheses, and then shift 6 on a regular computer is that caret sign that tells it what I want it to raise to the power of. And then I'm going to reference year 1 right here. Now, before I click away from this, I am also going to anchor the cell where I have the rate. Okay, so now I can drag this down. And if you see, each one is referencing what year it is. So this is year 5, that age 27, but it's all of them are referencing 13% because I anchored that cell. And then I typed in 1 and 1. So it was fine to drag that down. Now, if you go in the book and you look, these are the numbers that are in Appendix 12B-1. Just a note of caution on the exam, you will not have access to this appendix. So you're going to need to know this formula and the present value formulas and the net present value formulas. So get really comfortable with how to do that in Excel and make Excel work for you. So here we have, let's see, I'm going to add these up because I'm going to show you something later. So if I add these up, that gives me my total of discount factors for the 5 years. I'm going to use that in a minute. But first, I'm going to get what is the present value of my inflows and outflows each year. So the year 0 or the now, which is when we paid for the machine, is just, it is what it is. There's no discount factor. And then for each of the success following years, it's going to be the operating cost reduction times the discount factor. And I'm going to drag those down, and it gives me the discounted for each one. It's just that cost reduction times the discount factor for each year. And then if I do equals sum, because this is negative and those are all positive, Excel will do the calculation for me, and I will get a net present value of negative 6,104. Okay, so that's the long way to do it. Now, a shorter way to do it would be with a chart like this. And the only time you can use this way over here is when every year the cash savings or the inflows are identical. Okay. So the purchase of the machine, which is now, is going to be equals a negative of that machine purchase, so negative 36,000. And then years 1 through 5, that's going to equal the operating cost reduction. And so my total cash flows is just 36,000 for that. And then 85,000, 8,500 for that. Okay. So in the now, again, there is no discount factor. So the present value just is that, because we don't have any other calculations in that in the now. For years 1 through 5, this is where I'm going to reference that total of the discount factors over here. So, whoops, that should not be a dollar sign. That should be a number. And I want 3 decimal places. Okay. So now I just take 1 year's worth of the cash flow and multiply it by the total discount factors. So equals 8,500 times 3.517. And that gives me $29,896. So now I can sum these two numbers and I get the same answer, 6,104, negative 6,104. Okay, so that's the quicker way. Now, the even quicker way equals PV, reference the rate, right? That's the first one that they want, is the rate, comma, the periods, which I don't have that anywhere, so I'm just going to type in 5 because it's 5 years. And then the payment is the 8,500 because, right, I'm just doing the present value of the cash inflows. I don't have a future value, and I don't need to put a type. I can just close the parentheses there. And that gives me, oh, I forgot. I didn't want that to be negative. So I either need to put a negative in front of the payment, or I can put a negative in front of the PV so that that will show as a positive number. Okay, so, and that's the same as this. And so if I sum these together, I will get the same negative 6,104. So that was 3 ways to get to the same answer. And in this case, because they're having it, we put things in negative if they are negative and round the answer to their whole dollar amount. I did not have to do a hard input on these numbers. Sometimes with Excel, when you do this calculation, the 1 divided by 1 plus the rate raised to the value of the year, Excel has lots of numbers hidden in there, right? And that can skew your number. And since this gets graded by a computer, it needs to be exact. But because this one, they're rounding it to the nearest dollar, it will come out all right. In other questions, what I mean by a hard input is I would have Excel do this calculation, and then in the cell next to it, I would type in 0.885, 0.783, 0.693, etc. But in this case, I didn't have to do that. Okay, so really that's the end of required one. Whichever way you want to do it, just remember if you do PV, you have to then sum the positive 29,896 and the negative 36,000 to get to the net present value answer. Okay, now required 2, they're asking a different kind of a question. They want the total difference in undiscounted cash inflows and outflows. So right up here, we use the discount factor and we discounted all of these inflows of cost savings. So in this question, we take the annual cost savings of 8,500 and times that by 5 years without doing anything to it. There's no discount factors involved. It's just the cost savings times the number of years equals the total undiscounted cash inflow. And then my initial investment, again, is going to be negative because I spent the money. So negative of what the machine purchase was. And that only happens once. And so that times 1 year is just that. And then equals sum of those two numbers gives me a positive 6,500. So I think what they're doing here is just showing you if you don't do a discount factor, then it makes it look like you're going to make 6,500, when in reality, if you look at the net present value of money, it's actually negative 6,104. So that is question 1. Okay, question 2. This one gets a little tricky, but we can do this. Oxford Company has limited funds available for investment and must ration the funds among 4 competing projects. Selected information on the 4 projects as follows. So it gives me all this data. And so I just took and I typed in all of those numbers here so that I can reference them. And I triple checked them so that I made sure I didn't make any typos, because if I make a typo, my answers are going to be wrong. Okay, so what they're asking me to do says the net present value should be computed using a 10% discount rate. That's nice, but they already gave me the totals, so I don't think I need that. The company wants your assistance in determining which project to accept first, second, and so forth. So most profitable. But first, so required 1, all we're going to do is compute the profitability index for each project. And the definition of profitability index, or the formula, however you want to state that, is the cash inflows divided by the investment required. So for A, that will be the present value of cash inflows divided by the investment required. So, and I'm rounding it to 2 decimal places. And this is just a number. It's not a percent or dollar sign. It's just an index, the number. And so now I can just drag that formula down, and that fills all those in. You see, it's the inflows divided by the investment required for each project, A, B, C, and D. So that's all you need for required 1. Now, required 2 gets very interesting. So net present value. So it took me a while to figure this out, but I finally did it. The definition of net present value is the total sum of the cash inflows and outflows of the present value of the inflows and the present value of the outflows, right? The investment required is our outflow. The present cash, the present value of cash inflows are our inflows. And so for each one of these in a different spot, I'm going to go for A, my inflows minus my outflows. And that tells me that's my net present value. Okay. So I didn't have to use the 10% discount rate because they already figured out the present value for me. So thank you for that. So in each of these, again, I can just drag it down. I'll just show you. For C, it's the inflows minus the investment required, the outflow. Okay, so now I just need to rank these from highest to lowest because we want the one that is worth most first. So our first, and again, double check and do your own calculations on this because for my numbers are different than yours. So it's possible that your answer could be different than mine on these, or it could be the same. I don't know how they work those kind of things. So the first preference is going to be the 104,036. And then next is going to be A at 99,323. And then next will be the 97,000. So that will be B. And then obviously the last will be C. That's the only one left. Okay. So there's that. Profitability index. That, let's see, that's not that. Oh, that's the one we figured out up here. So look at your numbers and the one that is highest is going to be your first preference. So for mine, it's C. Whoops, I don't capitalize that so you can see it better. So it's C, and then my next highest is B, and my next highest is D, and the last one is A, right? Because 1.9, 1.72, 1.63, and then 1.62. Okay, and then internal rate of return, it's just this number that they gave you here. And again, highest to lowest. So mine is going to be the 22%. Whoops. Let's just see. And then the 18%, and then the 17%, and then the 15%. So 22%, 18%, 17%, 16%. So again, look at the numbers that you were given and just rank them highest to lowest. So all of these, you're going highest to lowest, and that's required too. Okay. Question 3. We're going to make a chart because we can, and it'll help us. Oakmont Company has an opportunity to manufacture and sell a new product for a 4-year period. The company's discount rate is 18%. So my discount rate is 18%, and I set my chart up for now and years 1 through 4. After careful study, Oakmont estimated the following costs and revenues for the new product. There's my cost of equipment needed, working capital needed, overhaul the equipment in year 2, salvage value of the equipment in 4 years, and then revenues are sales revenues, variable expenses, and fixed out-of-pocket operating costs. Okay, so in the now column, it's going to be negative of my cost of equipment needed. So for mine, that's 260,000. So that number right there, 260,000. And in the now, working capital investment is also a negative. That's an outflow of $87,000 right there. Okay, so that's all I need for the now. And so my total cash flows for now is just going to be a sum of all of this. And I'm going to drag that formula across because that's what my total cash flow is. It's just the sum of whatever ends up in that formula. So purchase of equipment and working capital of investment, they just go right here for now. Sales. So for each year, my sales are 430,000. So drag that across to all of them. My variable expenses for each year are negative because it's an outflow, 210,000. That's the same every year. My fixed out-of-pocket operating costs are, again, that's an outflow, so it's a negative 88,000. And that's the same every year. Okay, overhaul of equipment in year 2. So this is an expenditure, but it only happens in year 2 for negative 10,500. Okay. Now, when the project concludes in 4 years, the working capital will be released for investment elsewhere in the company. That means this 87,000 that I invested at the beginning, in 4 years, I get it back. So a positive 87,000, right? Same as here, only it's a positive because I get it back at the end. And then the salvage value, that means that's money I get back. So that's a positive of 13,500. Okay. So again, each of these is just the sum. And because I have positives and negatives and I use the sum function equals sum, then Excel does the calculations for me. Okay, so now I have my total cash flows for each year, which that's nice, but I need to know my discount factor. So in year 0 or now, there is no discount factor. So the present value is simply that total. Okay. Now, if you remember the formula, so I could go find the appendix, but that takes too long and later you won't have access to it. And so it's simply going to be equals 1 divided by parentheses 1 plus the rate, and I'm going to anchor that cell. Yes, I'm going to anchor that cell. Close parentheses, raised to the value of the year. So that's why I put these years up here by themselves so I could reference them as a number. And then I can just drag that formula across to each year, or you can type it in several times and practice. Now, this is the one where I was talking about. If you look, and if I increase the decimals, there's all these extra numbers, and Excel hides them for me because it can. But if I reference this cell to get my present value, it's going to skew the numbers enough that you'll get the wrong answer in this problem. So, whoops, other way. So even though I've made this so that there's just 3 decimals, I'm going to do what's called a hard input, 8.47, where I just type in this number so that that's all there is, right? So I can increase the decimals there, and it is that number that I typed in, no matter how many zeros after it, it's just 8.47. So do that for each of these, 0.718, 0.609, 0.516. So again, if I went to the appendix 12B-1, these are the numbers that would be there for each year for my discount rate of 18%. But you're going to need to know the formula, so you might as well practice now. Okay, so now present value, again, it's going to be that total that I figured out, multiplied by the discount factor, but make sure you reference the hard input, not the one with the formula. Then I can drag that across. Okay, So now I have each year's present value, but I need the net present value, which means sum these numbers. So equals sum and reference all these across. Close parentheses. So my net present value is 52,399. And they said to round it to the nearest whole dollar amount. Okay, so that is, I believe, everything you needed to do for question 3. Question 4. The Right Way ad agency provides cars for its sales staff. In the past, the company has always purchased its cars from a dealer and then sold the cars after 3 years of use. Okay. The company's present fleet of cars is 3 years old and will be sold very shortly. To provide a replacement fleet, the company is considering 2 alternatives. So we're going to be figuring out 2 alternatives. We're going to figure out purchase alternative and we're going to figure out lease alternative. So required 1 is figuring out the purchase alternative. The company can purchase the cars as in the past and sell the cars after 3 years of use. 10 cars will be purchased. So I'm going to put 10 right there for how many cars. At a discounted price of $21,000 each. I'm going to put that right here. So that's my price per car. So there's my number of cars, price per car. And then we know it's for 3 years. And it's down here. So the rate, Right Way ad agency required rate of return is 15%. Okay. So I need all of this information where I can reference it. So the annual cost of servicing taxes and license is $3,700. Repairs the first year, $1,600. Repairs the second year, $4,100. Repairs the third year, $6,100. Okay. Okay, so for the purchase alternative, I believe I pulled all of the relevant information out. So I'm going to make a cute chart, just like before. So the now is going to equal a negative, right? Because we're purchasing the price times the number of cars. So a negative 210,000. And that's all that goes in now. So there's that. And this is year 0. So there is no discount factor. This is now. So that just equals that. And we'll get to that in a minute. Okay. So year 1, annual service. That's a negative, right? So a negative 3,700, and that is an annual cost. And so, whoops, I can drag that across. Whoops, no, I can't because I didn't anchor it. Try that again. Anchor this cell. Now I can drag it across. Okay. So each year the repairs are a different number, and that's why I'm making this whole chart because each year is different. So this equals a negative 1,600. Year 2 equals a negative 4,100. And year 3 equals a negative 6,100. Now, somewhere right here, at the end of 3 years, the fleet could be sold for 1/2 of the original purchase price. So my resale value is positive, right? I'm going to make that money, and that is going to, so in order to reference this, I'm going to, again, negative and negative, and that makes a positive. So divided by 2, because it's in half. So I have a positive 105,000 coming in, because that's half of this. Okay, so I can drag this formula across to sum all of these numbers, right? That plus that equals this, and so forth. And this summed, right? Because I have positives and negatives, gives me that. Okay. My discount factor. There isn't one here. So again, we're going to go equals 1 divided by parentheses 1 plus my rate, anchor that cell, those parentheses, raised to the value of which year it is. So that gives me the discount factor there. And I can drag that across because I anchored the cell. And so again, year 2, it's going to reference raised to the value of 2. And year 3 is raised to the value of 3. Remember, we need to do a hard input so we get accurate answers. So 0.870, 0.756, 0.658. Okay, now I can do the multiplication. So equals that total cash flow year 1 multiplied by the number I typed in. And I can drag that formula across, and it gives me each year's present value. And again, we need net present value, so we're going to equal sum, and we're going to reference all of these 4 numbers, close parentheses. And so in the long run, the net present value for this one is a negative 157,866. So we're rounding to the nearest whole dollar, and we're entering things with a minus sign. So that is our purchase alternative. Lease alternative. What's my information here? Required 2. The company can lease cars under a 3-year lease contract. The lease cost would be $56,000 per year. So the cost is $56,000 per year for 3 years. The first payment is due at the end of year 1. As part of this lease cost, the owner would provide all servicing and repairs, license the cars, and pay all the taxes. Rightway would be required to make a $13,500 security deposit at the beginning of the lease period. So $13,500 deposit, which would be refunded when the cars were returned to the owner at the end of the lease contract. And again, my required rate of return is that same 15%. Okay, so right now I have to do the security deposit. So it's negative 13,500. And that's all that goes in now, because that first payment, if you remember, where did it sit? The first payment is due at the end of year 1, which makes no sense. I don't know what business would let me do that, but I'll take it. And so that first annual payment goes in year 1. And it is an outflow of 56,000. So I do negative. And if I anchor that cell, then I can drag that across because that's an annual payment for year 1, 2, and 3. My refund of my deposit at the end of year 3 So I get my 13,500 back, and then I can sum these whoops, equals sum. Okay, let's try that again. Equals sum of these. Okay, now I can drag that across, and that gives me my totals for each year. So my discount factor, I don't have one here. So my present value of now is just that deposit. Discount factor for this one is going to be equals 1 divided by parentheses 1 plus the rate, anchor that cell, raised to the value of the year. And because I anchored the cell, I can drag that across so that each one references the year. So again, if I went to the appendix, I could find those numbers, but this is so much easier than trying to look that up. But I do need to type them in. Hard input of 0.870, 0.756, 0.658. Okay, so each year, then I will take the total cash flow times the hard input discount factor, drag that across, and that gives me those numbers. So then my net present value is the sum of these numbers, close parentheses. So for the lease alternative, it's a negative 132,521. So required 3, they want to know which alternative should the company accept. So be careful here because both of them are negative numbers. Which one is less negative, right? Which is one is going to cost me less, and it's the least alternative is going to cost me less. So that's what they're going to choose. Okay, so that leaves everything you need for question 4. Question 5. Okay, Lou Barlow, a divisional manager for Sage Company, has an opportunity to manufacture and sell one of 2 new products for a 5-year period. So 5 years. His annual pay raises are determined by his division's return on investment, which has exceeded 23% each year. So his return on investment has normally been 23%. That's going to come in handy later. Each of the last 3 years, he has computed the cost and revenue estimates for each product as follows. So I need to put those numbers in here. So initial investment, whoops, cost of the equipment is 310,000. The product A, 510,000 for product B, and I'm just getting those numbers right here. Sales revenue, 360,000 for A, 460,000. Whoops, I missed a 0. For B, variable expenses, whoops, are 164,000 for A, 214,000 for B, depreciation expense, 62,000 for A, 102,000 for B, fixed operating out of cost, pocket cost, 81,000 for A, and 65,000 for B. Okay, that was all important stuff that I'll eventually need, I'm sure. Here's what I was looking for. The company's discount rate is 18%. So don't get confused between the two percentages that they gave you. This comes in later when we're talking about return on investment. This 18% is our discount rate, when what we'll use to get our discount factors. So required one, calculate the payback period for each product. So if you'll recall, payback period is the annual net cash inflow, the cost of the initial investment in the equipment divided by the annual net cash inflow. So in order to find the inflow, we need to have the revenues for A. We have a negative variable expense, and then we have a negative fixed expense. So the reason that we do not take into account depreciation expense right here is because this is not a cash transaction, and they just want to know about the cash in and outflows. So we equal sum product A, and that gives me my annual net cash inflow. So for product A, I will take the initial cost of the equipment divided by the annual net cash inflow that I just figured out. So my payback period rounded to 2 decimal places is 2.70. Not a percent, it's not dollars, it's just a number. Okay, so product B, same thing. Sales revenue, 460,000. Variable expense equals a negative variable expense. Fixed expenses equals negative fixed. And then I can just drag my sum formula over, and that gives me B. So then I will just take my initial investment for B divided by my annual net cash inflow. So I get 2.82. Okay, so there's required one. Now, required two, they want us to calculate the net present value for each product. So again, lots of ways to do this. Let's do this way first. So for product A, the now is equals a negative initial cost of the equipment. And then years 1 through 5, because it's the same every year, equals 360,000. Variable expenses are equal to negative 164,000, and out of pocket equals a negative fixed operating cost. So total cash flows of now just equals the investment. And then this one equals the sum of these three numbers. Okay, so apparently I do want to do this chart over here to get the present value. I'm going to finish filling in B, so equals the negative initial investment, and then years 1 through 5. So my sales revenue for B equals a negative variable expenses equals a negative fixed cost. And then my total cash flows, sum those numbers. Okay, so if I go to Appendix 12B-1, these are the numbers that are there. But just to show you, because I went earlier and copied those numbers for my discount rate of 18% for 5 years, years 1 through 5, 1, 2, 3, 4, 5. Okay, so over here, I'm going to do the 1 divided by the 1 plus the rate raised to the value of the years. So equals 1 divided by 1 plus the rate, 18%. Oh, I forgot my parentheses. Raised to the value of year 1. So see if it just gives me all of these numbers. So, but I'm going to type it in again. 1 divided by 1, whoops, parentheses, 1 plus the rate, 18%. Oops. And you also have to do equals in front of it or Excel doesn't know what you're doing. So equals the rate, close parentheses, raised to the value of year 2. So equals 1 divided by parentheses, 1 plus the rate, close parentheses, raised to the value of year 3 equals 1 divided by parentheses, 1 plus the rate, close parentheses, raised to the value of year 4. And then 1 equals 1 divided by parentheses, 1 plus the rate, close parentheses, raised to the value of year 5. So see, it's just like I was telling you, those digits, they're exactly what these are, rounded to 3 decimals. So because I took these straight from the appendix, those are my hard input. So I am going to be referencing those numbers. So if you look at this total cash flows, this is for 1 year with no discount factors, right? And I know that the present value of now is just, it is what it is. There's no discount factor needed. So over here, I'm going to do these 1 year at a time. So equals that 115,000 cash inflow. And I'm going to anchor that cell because that's going to be in each one of these. And I'm going to times that by year 1 discount factor. And notice I'm using the one that's a hard input, not the one with all of the numbers. So 97,405. And because I anchored that 115,000 total cash inflow, I can drag this formula down through year 5. And then I can take equals sum those numbers. So that gives me the present value for A of 359,605. So my net present value equals the sum of the outflows and the inflows. So net present value of A is 49,605. So that is the answer for required 2 of A. So product B, let's do the same thing, only this time it's the 181,000. So I'm going to go equals 181,000, anchor that cell, times year one's discount factor, and then drag that down. And then because this is a sum formula, I can drag that formula over, and that will sum those numbers for me right there. So let's see, right here, we know the now for B just equals that. That's the present value of now. There's no discount factor. And then the present value of years 1 through 5 for B is that total right there. So then the next present value is the sum of the outflows and the inflows. So product B equals 55,987. All right, so that was required too. And I'm sure there's lots of ways to get to that, but that's the way I did it. It would just made sense to me because there's just little quirky things in this one. Okay, profitability index. You'll recall profitability index is the present value of cash inflows divided by the investment required. So for product A, the present value of cash inflows was, let's see, whoops, Control V. Let me make sure I'm doing this right. Yep. Okay. So it's going to be that present value of cash inflows for all 5 years divided by the investment required, which I'm going to reference this one over here because it's a positive. So I get rounded to 2 decimal places, 1.16. So for product B, the present value of the cash inflows for all 5 years divided by the initial investment. So I get 1.11. Okay, simple rate of return. Annual incremental net operating income divided by initial investment. So my annual, right? I'm doing annual. So my annual incremental for A was the 115. And B is the 181. That's the inflow. Depreciation expense. Need to take that out because that is not a cash transaction. And so there's B's depreciation. So we're going to subtract that because now we're talking about net operating income. We're not talking about cash flow, right? This is cash flow. Depreciation is not a cash transaction. But to get to simple rate of return, now we're talking about net operating income, and depreciation is a part of that calculation. And so we take the cash inflow minus the depreciation because we need annual incremental net operating income. So same thing over here, cash inflow minus depreciation expense. So just for simplicity's sake, there's my initial investment for A, and there's my initial investment for B. And so to get simple rate of return, I take the annual incremental net operating income divided by the initial investment. And this is a percent rounded to 1 decimal place. So 17.1% there and 15.5% there. So again, it's the incremental net operating income divided by initial investment. And the reason we're taking depreciation expense into consideration is because now we're talking about net operating income, so which is an accounting thing. And so we do take that into consideration. Okay. Required 5A. For each measure, identify whether product A or B is preferred. So net present value. Right here, net present value, that was required 2. Which one is worth more? Product B. Profitability index. That was required 3. And we want the one that is higher, not much higher, but it's a little higher, 1.16 versus 1.11. So we want the one that's higher for profitability index. So that is A. Payback period. Clear back up here for required 1. Product B gets paid back slower, right? Yeah. So we want the lower number because that means it's paid off sooner, right? We're talking about how much of a year, so 2.7 of a year versus 2.82 of a year. So product B takes longer to pay off. So we would pick product A because it will get paid back faster. So payback period would also be A. Simple rate of return. So this one, again, this is like interest on your savings account. So you like a high percentage is better. So product A is a higher percentage than product B for my numbers. So again, double check your numbers because your numbers are different than mine. So we could have the same answers here or we could have different. So do your calculations. Okay. Based required 5B. Based on the simple rate of return, which of the 2 products should lose division except? So if you remember rate of return, that was that, let's see right here. Return on investment, they usually have been getting 23, more than 23% for each of the last 3 years. So they want to pick one that would be more than this percent right here. All right, not your discount rate, it's the other one that I told you not to get confused with. So they'll choose a product that is higher than this ROI percent, which in this case, if you look at required 4, the rate of return, neither of them are higher than the 23% that is required in my problem. And so they would reject both because they do not exceed the rate of return that they've been getting for the last 3 years. All right, best of luck with this.